Welcome to Dolfin's Q3 2020 investment outlook. We're going to spend roughly an hour to an hour and a quarter, we'll see how we get on, talking you through a little bit about our model portfolios, performance, positioning, what we've been changing investment strategy-wise, update on macro environment, what's been happening in the fixed income market, equity market, and then this time we're going to finish off with a brief discussion about the sort of working from home concept, partly looking at some of the changes that we're seeing from a sort of fundamental way of life perspective, and also looking at some of the investment opportunities that are arising because of this new environment and dynamic that we're all in. As you can see on the right hand side, I've got a host of handsome colleagues that are joining, and we'll sort of have people jumping in videos, save you having a maze of faces trying to work out which one of us to look at and follow along with. Moving on to the performance aspect, I'll talk you through a little bit about our performance in June, also year to date, but more importantly, what we've been changing over the last quarter from a strategy, holdings and allocations perspective. So just skipping on to June, we're running 9 global multi-asset models. All 9 of those are positive in June. Looking on the right hand side, when you've got nice positive equity markets, it makes it quite easy to generate positive performance in client accounts. We have, if you look at the performance of our portfolios versus the ARC Private Client Index, so from a peer group comparison in June, we were underperforming because we continue to be quite conservatively allocated from a risk perspective. We're going to talk in a little bit more detail about how we're sort of seeing this disconnect from equity market prices, bond yields, and the underlying macro economy. I'm sure James will give us a few insights and thoughts on that shortly. So our sort of top line takeaway from June was positive, slightly less so than our peer group because we're focused on this absolute return and slightly more conservatively positioned than quite a few of them. You start to see that coming through when we skip on a year-to-date performance basis. Sort of average peer group, all 9 of the relative year-to-date numbers are negative. We've got 8 out of our 9 models are positive on a year-to-date basis now. Obviously the Euro conservative, the hardest hit one, but when you take a little look down to the bottom right hand side and you realize that a lot of the European government bond market yields are negative and have got more negative so far in 2020, it's difficult to build a balanced portfolio. And this is some of the issues that are now starting to creep across into the rest of the markets as well, with interest rates in the US and UK coming down to very, very low levels. You can kind of see that coming through here in terms of some of the comparative bond yields for the UK and the US 10 years and how much that's changed over the course of the last 6 months. Not just the market environment and the economic environment have both changed substantially, and even over the course of the last month we've seen the same from a portfolio perspective as well. So you can see that we've been reducing our sort of cash equivalent bucket and deploying that into a combination of investment grade and a little bit more high yield, as well as continuing to build up our equity exposure and our first allocation to core equities over the course of 2020. I think the best way to describe the investment into core equities was begrudgingly done. When you're looking at the sort of fundamental underlying macro environment and you're kind of looking at where equity markets are, we were reluctantly deploying into markets that continue to move higher on the back of plenty of stimulus, liquidity, and support from central banks and governments around not just the developed world, but essentially on a global basis. This is having a significant impact on our investment strategy and is going to have a knock-on impact for years to come, given that short-dated government bills are no longer providing either a positive nominal return or a positive real return. So the whole concept of how you structure a portfolio, how you invest in a portfolio, and how you try to generate positive returns moving forward is getting increasingly complicated. We're sitting in an environment, and we'll touch on it in the equity section, where the idea of buy and hold is becoming increasingly difficult. When we're seeing some of the valuations at an index level, which kind of indicate limited positive returns in the years to come. That's why when you look at the split of global equities versus satellites, we have a much higher allocation to satellites, but our investment strategy within the equity component is going to be more active moving forward than it would have been over the last 2 to 3 years. And I say that because the idea of this buy and hold as everything moves higher has kind of hit the end of that game to some extent that we've been playing for the last 10 or 11 years. Now more than ever, it's going to be a lot more about individual companies, sectors, and those sort of business models that you do have exposure to. That's why we're picking up on the working from home aspect, because that's kind of looking at some of our holdings through a slightly different lens. That's probably enough of me to get the ball rolling, because I can now start passing across to my much more learned colleagues. As I said, we've been very conservatively positioned over the course of 2020. We had limited negative performance in March because of our very low equity exposure. We did come up with, in March, April, our COVID-19 redeployment strategies. We are going to touch in those in both the fixed income and the equity sections, so to give you a bit of an update on what we have been buying and a little bit as to why. But I think for the time being, I will pass across.
Fantastic. Thanks, Simon. So it's been a very interesting quarter, to say the least. And we're following up on the first quarter, which I found myself having to put a pound coin into the kitty every time I said unprecedented. And sadly, I'm still filling that pound coin jar. So what I'm going to talk to you about today is the output that was lost in this recession, or is in the process of being lost, and what kind of a growth pothole we're dealing with. And I'm going to be talking a little bit about how fiscal and monetary policy is helping to fill in that gap, at least in the short term. And then I'm going to end with some conversation about, or some discussion about the imbalances and perhaps even bubbles, the B word, that we're potentially looking at as we move into the longer term. Now, the lockdown was an enormous blow to the global economy. If you look at the quarterly change at an annualized rate for global GDP, which has historically been extremely steady, we are looking at a second quarter of close to 20% negative, which is miles and miles beyond the worst that had ever been seen for the global economy. The prior low being hit in the 2008 recession. And so this explains why reopening, which has been taking place over the course of the past 2 months or so, has been such a big boost. The sharp decline, followed by even a partial reopening, gives you a big quarter-on-quarter or month-on-month move. And this explains a lot of the current market optimism. So even if things aren't good, they're clearly better. And this is a fact, they are better. The problem is that the degree of better can be exaggerated. So on the left hand side of the screen, you can see the quarterly change at an annual rate. And you can see that the sharp decline this time around is followed by a very steep rally, which is of the same magnitude. And that's very different from what we saw in the 2008 recession, followed by a subsequent return to trend. Now, a lot of people might look at that and think that that marks a full recovery, but that doesn't. And the reason is because we're talking about percentage changes, and people are not very good at thinking about percentages when magnitudes are large. This is just a result from the behavioral finance literature. So for example, you take a 50% decline and you follow that with a 50% rise, and that leaves you still down by about 25%. And it takes a 100% rise after a 50% decline to get back to flat. And I know that when I say this, everybody nods their head and says, yes, that's true. But I think when you look at the chart on the left-hand side, your instinctive reaction is say, phew, that big recovery means that we're back to normal. Well, we're not. If you look at the global economy or the global GDP in level terms, on the right-hand side, the 2008 recession gave you a pothole or a gap in output, which is what you see with that small red triangle, that took about 5 quarters to recover, and it subtracted about 1.3% from global GDP, and that was permanently lost. In the current recession, I don't expect that the market will recover its pre-COVID-19 level until about mid-2021, which means that the vast majority of those who took this poll would disagree with me. Only 2 people thought that we will recover that level by late 2020 or mid-2021. Most people think that we'll recover that level in 2022 or beyond. So indeed, I am on the optimistic side of at least the people participating in this webinar. Nonetheless, that comes out to almost 5% of global GDP permanently lost by the time you've finished doing the math. And this is by miles the biggest decline that we've seen since World War II. Indeed, 2008 marked the first outright decline in the free market globally since World War II. So this is a very significant downturn. And what makes this even more sort of troubling or problematic is that the latest data suggests that the early recovery from unlocking may even be stalling out. And in part, this is because easy gains have already been made. And in part, this is because resurging infection rates, particularly in the United States, are prompting some states, some regions, to reintroduce mandatory social distancing measures. So if we think about what this means for the long-term growth outlook, then the pandemic is probably going to result in permanent changes in consumer behavior and firm profitability. And that seems very, very likely. And it's probably going to be several years before a new growth equilibrium is reached. If we move on to the next slide, what we're going to then talk about is how uncertainty has pervaded this market over the past several quarters. It's been a very central feature over the past 6 months. So the pandemic caught everybody by surprise, unless nobody saw the pandemic coming. And so this immediately forced economists to very quickly estimate something that was unprecedented. We've never locked down the global economy in anything like this kind of a fashion. So the speed and the scale of the policy response, however, was also a surprise. So this then has required economists to estimate the unprecedented follow-up to the unprecedented. And so it's not really a surprise that if you look at the economic surprise index, which measures the extent to which economists and analysts have missed in their forecasts for underlying economic data, we've gone from a record low very swiftly to a record high. And in fact, the right-hand chart shows you that if you look at the change in that index on a rolling quarter basis, it's by miles the biggest switch from record low to record high that we've seen in the history of this series. So this is just a way of thinking about how the really abrupt changes and swift moves that we've seen in the market have filtered through to how economists and analysts do their day job. I actually think that economists have done pretty well in coming to grips with this crisis. It took several weeks, but they quickly converged to new high-frequency alternative data sources to try and measure the economy in real time. And a broad consensus has formed about the rough shape of the economy over the course of the next year or two. So we're no longer talking about a V. We're not talking about a U per se. We're talking about something a little bit more tick-shaped or Nike swoosh-shaped. And I think that's generally now accepted. There's a lot of disagreement out there about the timing and the scale of the recovery, and that's understandable, given how unprecedented this whole sequence of events has been. There's deeper disagreement about the longer-term implications for public sector debt, for post-pandemic economic growth, and for inflation. And I think these are three very important questions that need to be wrestled with. Putting it together, all of this economics uncertainty, unsurprisingly, has translated into earnings uncertainty. And this is a subject that my colleague, Mikhail, is going to be speaking about in a few minutes in this presentation. So moving on to how this pothole was filled in by the policy makers, by the governments and the central banks. So that word unprecedented, I need to find a replacement for it. There was an unprecedented fiscal stimulus. As a percentage of world GDP in 2020, I estimate that that there's about a 4 percentage point stimulus that has been added to global growth from spending across different governments. So just to put that into context, what I'm saying is once you've adjusted for the cyclical, the counter-cyclical spending that governments normally engage in, unemployment benefits, et cetera, and so forth, there's still about 4 percentage points of GDP that was added to global growth because of that spending. And that's an enormous number. If you add up the amount of fiscal stimulus from the 2008-2009 recession, that came in at just under 3% over the course of 2 years. So already in 1 year, we're something like 25% more stimulative than we saw in the last recession, which had been the worst recession since the Great Depression. Now in 2021, that stimulus is going to start to become a headwind as opposed to a tailwind. There's no such thing as a free lunch. You know, somebody's going to have to pay, and inevitably this is going to be a fiscal drag on growth. So if we were to keep the fiscal support flat, governments would have to continue adding another 4% to GDP in spending every year. That's clearly not going to happen. In fact, I think that governments are going to continue to be supportive and fiscally accommodative, but just by being less supportive, that's going to work out to a subtraction of about 2 percentage points from next year's GDP level. So straight off the bat, the private sector is going to have to make up for about 2 percentage points of fiscal drag from the winding down or the deceleration of the fiscal stimulus. Now, the other component that's been helping us get through that big red pothole I showed you on the first slide is monetary policy. So on the right-hand side, what I show are the G4 central banks' balance sheets as a percentage of world GDP. And this is I think, probably the best way of measuring how much quantitative easing has been deployed in order to support activity. Prior to 2008, the Japanese were the only people who were even trying to use QE, and they've not really had an enormous amount of success with it. And the G4 central bank balance sheet prior to the global financial crisis was sort of steadied around 5 to 7% of global GDP. That surged during the GFC, which felt like quite a lot of money. It was never unwound, continued to rise, and since it surged again. So we're now looking at about 25% of global GDP is being deployed via central bank balance sheet. That is a huge number. And again, this is one of those things which is really going to be difficult to continue indefinitely. It's been incredibly helpful for managing the crisis in the short term, but the process is quite complicated. And my colleague Adrian is going to be spending a few minutes a little bit later talking about how this balance sheet expansion has played out in the rates market. So if we move on to the next slide, then I can show you sort of a real world example of how this all plays out in how the economy has actually been supported. And I'm going to use one example here, which is the state of US employment, how people in America have been getting paid. And this is really very crucial. The two sort of key characteristics of a recession are the extent to which unemployment occurs and people lose their jobs and thus their ability to spend, and the extent to which there are bankruptcies and defaults, companies shut down and thus unable to employ. So typically you would expect unemployment benefits to pick up in a recession. As people lose their jobs, governments provide them with unemployment benefits. These checks help to balance out their consumption during the recessionary period. And if you look at the chart on the right, you can see that from 1960 through the GFC in the mid 2000, late in 2008, 2009, those are unemployment benefits as a percentage of total employment income in the United States typically peaked at around 2%. So you go anywhere from about 0.5% on a normal sort of expanding economy basis to a surge of about 2% during a recession. Now, what's happened now is that in May, the US government dramatically increased the amount that it was providing as a benefit to individuals and to those who are unemployed. So now those unemployment benefits constitute about 11% of total employment income. And that's just it's an astoundingly large number if you think about it. About 10% of the money that US employees are taking home is directly from the US government. You can see that on the left-hand side of this chart, of this slide, that actually total employee income in May exceeded the pre-coronavirus levels entirely because of the unemployment benefits that the government has provided. So government benefits has more than filled this hole from lost wages for now. This is clearly not something that can persist. These benefits may be rolled back at the end of July. I think they're probably going to be extended, but they cannot be extended indefinitely. But this is how the fiscal stimulus has played out in helping to keep the global economy afloat through putting money into people's hands so that they could literally stay alive and continue to spend. So how does this then get us back to the business cycle and to equity earnings? So if we look at the next slide, equity earnings. So the earnings per share for the S&P 500, for example, closely track the business cycle. Ultimately, corporate earnings reflect economy-wide output, and they follow the ups and the downs of the business cycle very, very closely. And if anything, as you can see on the right-hand chart, these two have become even more synchronized in the past 2 or 3 decades. When the business cycle expands, earnings improve. When the business cycle contracts, earnings decline. But since the global financial crisis, there's a substantial wedge that's emerged between what the stock market is paying for earnings, so the price to earnings ratio, and what the stock market is paying for economic output. So here I measure that as the real S&P 500 versus industrial production in the US. It's stunning how up until 2008, there was an incredibly tight relationship between the price to earnings ratio and the price to output ratio. But starting in 2008, there was a real divergence. Now, they're tracking a different, very correlated, but what's happened, I think, is that quantitative easing and monetary policy from the GFC has pushed a wedge into the market's price for economic output. I think it's a bubble, and I think this is a bubble that has been building over the course of the past 10 years. It's a bubble that was blown by the first episode of QE, and it was never popped. The liquidity that we're now adding is dramatic, and it looks to me like it's going to further inflate that bubble. And this is really the crux of the dilemma that's facing markets today, and that Simon was alluding to several minutes ago. The upside for markets here is that there's a real drag from the economic environment and from earnings growth, because it's a very, very difficult situation, as I've shown you with this massive pothole in the global economic path. But on the other side, the downside is very limited because of central bank liquidity. So when you buy into the equity markets, you're paying an ever and ever higher price, either for corporate earnings or for economic output. But if you don't buy it, on the downside, you have central banks providing so much liquidity that they're blowing bubbles. And this is a real dilemma. How do I think you invest in this kind of a market? I think things go sideways. I think risk markets are going to trade sideways for the coming quarters, if not years. And this means that you need to be underweight or short at the highs. So for the S&P 500, you're probably talking about 3,200 to 3,400. And you need to be overweight or long at the lows, probably 2,200 or 2,400, that kind of range for the S&P 500. And if you're not managing your allocation, at least for the next few quarters or years, you're probably just going to see no return at all in your portfolio for the near term. So it's a different kind of market. It's a little bit tricky. Now, so one of the things that is coming out of this current environment, and that's the next slide, the last slide that I'll burden you with, is how there have been some divergences between different markets, some relative over and under performance. And I know that there's been a lot of attention paid to how the U.S. Stock market has been extremely strong relative to the rest of the world, relative to Europe. And one of the things that I'd like to point out is that divergence, that overperformance relatively between the U.S. market and other markets. So for example, if we compare the MSCI US equity index to the MSCI Europe index, which is on the left-hand side, it's the green line, you can see that the US has substantially outperformed the Europeans over the course of the past 10 years. But that has been matched all along the way by a stronger dollar. So the stronger dollar is a contributing factor, and it's both a cause of and caused by the relative outperformance of the U.S. equity markets. But it's a really important support for this U.S. performance. So if we look forward, I think that we need to be ready for a weaker dollar. I think one of the reasons why the dollar has been so strong over the past 10 years is that the U.S. Fed has had a lot more room to raise rates or to reduce its quantitative easing or shrink the size of its balance sheet than the Europeans or the Japanese or other countries have had. And what that's meant is that the dollar has lost had a lot of support from that interest rate differential, from that relative supply of money. Well, now that the U.S. has joined the rest of the world with zero, perhaps even negative rates, that support for the dollar is gone. And I think that we're going to be entering into a period of a sustained weaker dollar. That means that the U.S. is probably going to start to lose its attractiveness relative to other equity markets. So if you look at the outlook of the coming quarters and coming years, I think broadly risk markets are going to move sideways. And I actually think that what we need to do is look more at markets outside of the U.S. for opportunities, because I think the dollar, for one, is going to present quite a headwind for U.S. relative performance. So I'm gonna hit pause there, and I'm gonna open it up to any questions, if that's the right moment, Simon.
That is the moment. We have had one come through. I'm hoping that I don't regret asking you this, because
okay.
we have got other things to do later this evening, so try to limit the answer. Your question, and I'm going to go back to the relevant slide, which was what we were looking at when it came in,
Yes.
was how do you come up with the lost GDP forecast?
Okay, so if you look at the right-hand side of this picture, this is global GDP in 2000 US dollars. So it's adjusted for inflation, and it's the level of GDP. So if you if you see how global GDP hits a recession, it starts to decline in level terms, it hits bottom, and then it starts to grow again. Typically what happens is that there's a short period of above the trend growth rate expansion, followed by a return to trend. So those sort of dotted lines that you see extending from the solid line of GDP as a level, that's trend growth. The dashed line that you see on the right, that's estimates and forecasts. The left-hand side of the dashed period is not really so much a forecast as more of an estimate, because we have a lot of data for that first and even the second quarter now. But then it moves into a forecast. Now, these forecasts are not actually mine. These are provided by Goldman Sachs, which, you like the forecast or you don't like the forecast, but I've found that they're relatively good at being responsive to the data, very, very quick, very accurate. And also their forecast is very consistent with just about every other reasonable forecast that I've seen. What I measure with that red triangle that you see, those two triangles you see, one for the GFC and one for the current recession, is just the area underneath the curve that it takes to get back to the pre-recessionary level of output. So we hit our pre-recessionary peak in the fourth quarter of 2019, and that was at around $69 trillion for the global economy. And we're not going to get back there by this forecast until somewhere around the second, maybe the third quarter of 2021. So if you add up the area underneath that curve, you end up with about 4.8 percentage points of global GDP permanently lost. And that compares to about 1.25, 1.3 that was lost in the GFC, which, by the way, was the first time that the global economy had declined since World War II.
Rates markets, what can I say, there's very low yields available. And the one thing that James and I have been talking about a lot is the balance sheets for the central banks. And obviously, the one that we look at the most tends to be the Fed. Now, the Fed, during this crisis, actually increased their balance sheets by 3 trillion. But it's not going to be the end of the story, in our view. They have a lot more to do this year. And quite funnily enough, when we look at the amount of supply available in the debt markets this year, it is, to use James' words, unprecedented. The IMF basically have said that they expect the government, and this is government debt alone, debt to GDP ratio to increase from 88% last year to 105% by the end of this year. So that's an awful lot of supply for investors, for central banks to take upon. Are they going to be able to do it? That's the big question. Is there a big supply overhang? Now, if we look at the table on the right, we can see what the net issuance is projected to be this year. And we can see that for the US, where this is estimates coming from Goldman's, by the way, the net issuance is coming up 4.1 trillion, this year. And central banks are projected, the Fed is projected to spike 2.5. This means that there's potentially 1.6 trillion that needs to be bought by the end of the year. This dwarfs everything else by, if you look at the other countries. If we look at Europe, Germany has the biggest remaining supply, should we say, at 74 billion euros. Italy, which is one of our favored picks in the government world, is actually shows that central banks can buy more than's going to be issued based on current projections. So that's a pretty healthy situation to be in. The big question is, who is going to buy this supply? So if we move into the next slide, please, Simon. This is one of the charts which I look at. For me, the absolute level of debt leverage on a balance sheet is not the only factor. It's probably one of the factors we look at, but I would say it's the ability to actually refinance your debt going forward, but to cover your interest payments as well. And what we've noticed is actually the US Treasury has started issuing their debt through T-bills. This started not actually in this crisis, but in October 19, when the Fed wanted to start buying more T-bills to actually support the money markets, to keep the Fed rate upper band below its target, but it's starting to spike out as people are looking for overnight liquidity. What this has meant is that the Treasury has seen this and said, you know what, we can actually issue T-bills very cheaply right now. If you look at it, you're looking at 2-year bonds at 20 basis points. You're looking at T-bills roughly around 10 basis points. It's very cheap money for the US Treasury. And this has meant that despite all the fiscal stimulus they're doing, the actual interest expense is not increasing that much. It's actually below the peak by our calculations from 2019 as well. This means that the Fed has got a bit of a problem on its hands. If it raises rates, it's going to start actually increasing the actual interest expense for the US Treasury. So they're a little bit trapped in that sense, in our view. Now, this means that they have to keep rates low until the US Treasury starts terming out the T-bill or they start reducing their debts. For us, we see this as a way forward towards seeing yield curve control coming in by the Fed at some stage. I realise Powell has talked it down a little bit, but we do see the fact that they will have to keep yields actually low, especially at the front end, whilst the fiscal stimulus and these T-bills have to be rolled over at some stage in the future. If we go into the next slide, we can actually see that the market has been pricing in since the Fed intervention some form of yield curve control. If you look at the 2 years, the 10-year yields on offer, they've basically been going sideways for over the last quarter. This is sort of starting to look like the Europification that we're seeing in Europe. If you look at Germany, for their 2 years and 10 years, it's very tight ranges as well. So for the summer and next quarter, I'm expecting the actual 10-year bond yield to trade in a very tight range of something like 54 to 70 basis points. And potentially at the end of the year, we can, in a Q4, we may see a range of 75 to 100 basis points. That's not really that significant. But what does this mean? That there's actually very low rewards for me, or total returns, from actually buying and holding any treasuries at this point in time. You know, I'm only getting 4 basis points a month of carry. Any price performance is going to be very difficult. In fact, any negative price performance is going to erode any returns I get from my carry. So I look at the risk reward in the government bond market has very low at the moment. It's not very conducive as well. So if we go on to the next slide, this all raises a question. I'm an investor. Everyone here is investors. Would you be buying debt at these levels in US treasuries? If we look at the foreign investors, they've actually started putting a brake on their purchase of treasuries. And this actually started even before the crisis, back in 2015, when people expected rates to start rising. So we can see that actually, as a percentage of their holdings, the foreign investors aren't buying as much. And it's dropped again after this crisis. What does this mean? It means that either US domestic investors have to buy, or the Fed has to monetize this debt that's being issued by the Treasury. If we move on to the next slide, please. So this is the poll result, and you can see a lot of people here are expecting that you'd like to have a bond yield in real terms after taking inflation into account of over 1.5%. Unfortunately, that's not going to happen anytime soon, probably not for a long time, for the reasons I've actually explained. If we actually look at what the actual real yield is on a 10-year treasury at the start of this month, it was minus 0.86%. Therefore, we're actually losing money relative to inflation for holding US government bonds. For me, this doesn't really make sense. And this is why I'm actually underweight treasuries. I'm underweight governments across the board, because I don't see any real value. I can't see how I'm going to make any inflation-adjusted returns for people, for investors at these levels. This is why, even when I start looking at it and looking at the investment grade market, I'm a little bit more inclined to go there because at least I'm getting some real yield after inflation. But where I'm really looking at getting the biggest return possible is in the BBB corporate bond index, bonds at the moment. And we've been very selective about this, and Jeff will talk you through this. But you can see we've added these three names, Seagate, Las Vegas Sands, and healthcare name, into our portfolio. So we are getting over 1% roughly on these bonds. And the reason we like this is because the Fed, apart from buying treasuries, is actually looking at supporting the investment grade market. It's basically underwritten investment grade new issuance. It's also acting as a supporter of any fallen angels. So we like the BBB segment, especially at the moment. And what I'll do here is I'll pass you over to Jeff.
Great, thanks, Adrian. Now, if I just start off by building upon what Adrian touched upon in relation to debt load and interest expense, we can see here that looking at the most recent part of the credit cycle, growth in borrowing has far exceeded growth in earnings, which is why net leverage has been creeping up over the past decade. Now, in the second quarter, we do expect a precipitous drop in EBITDA, and that will drive multiples higher in this credit cycle. But we don't think this is so much of a problem because banks, in many cases, have provided covenant waivers on credit facilities and on term loans as well to companies for a temporary period of 12 months to those businesses that they expect will recover and will emerge from this crisis at least as strong. At the same time, although rating agencies, they've come through thick and fast with downgrades, there still have been holdouts where they've provided some leeway to companies that may see more of a V-shape and a more rapid recovery. So just look at this chart on the right. Although we do expect some deterioration in interest coverage, it's not that bad. When looking at investment grade names, it drops from roughly 10 times as a multiple of interest to only 8 times, and we do expect a path towards recovery. But what the low interest expense on a high base of debt does provide is a solution to the corporate's near-term liquidity worries. But longer-term debt sustainability is the question that we're beginning to ask, and what a lot of investors in the market are starting to focus on as we get back to the beginning of a new credit cycle. Now, if we just move on to the next slide, in the past quarter, we've seen both US investment grade and US high yield indices generate a total return of positive 9%. Now, it's been driven, that market rebound has been driven by the central bank pledges that James and Adrian have both touched upon, and the pledges to support the refinancing markets. Now, the chart on the left very clearly depicts how strong primary market activity has been. We've seen over $1 trillion printed in the first half of this year. Now, a lot of that has been accommodated by the low rate environment. There's also the need for cash and liquidity for this period of low revenue. And we also think that a lot of corporate treasurers and CFOs are thinking about getting ahead of the game and pushing their debt maturities out while they can, and certainly before the US election starts to gain pace. And this whole abundance of new supply, it's been balanced by strong inflows back into credit. So we've actually seen primary deals well supported in the secondary market afterwards, with the majority of deals actually trading tighter in secondary. Now, the other point that I'd like to raise is that if you look at the chart to the right, we've seen that there's been a notable change in issuer behavior. Now, on average, 49% of US investment grade companies have reduced their share buybacks when you compare it to a year ago, and 15% have cut dividends. Now, if you think about it, share repurchase programs are typically temporary and there's a lot of flexibility to pause programs, whereas companies have been slower to cut in dividends, and that's understandable because boards that represent the view of and the interests of shareholders, which include pensions, family-owned interests, reducing a dividend gives signal of a more permanent change in the financial policy. And we can see that a lot of companies probably don't want to rock that boat just yet, but it does give us a degree of comfort that there's plenty of headroom for companies to cut dividends in the event of an unfavorable market outcome, whether it pertains to the US election or some escalation in the risk related to the US and China trade war. If we just move one more slide forward. Now, looking at these two slides, downgrade activity, it's unsurprisingly, it's shut up over the last 2 quarters. Fallen angel tally for this year now totals 200 billion, and historically, downgrades continue beyond the downturn. And that's because we see a lag in rating actions. That lag arises because rating agencies, they want to make a decision on whether these higher debt loads that have been taken on are sustainable or not, whether the change, the additional debt, it's structural or whether it's temporary. And if you actually look at the implied credit metrics, they actually point towards a lot more downgrades than we would expect. So the rating agencies are clearly giving a little bit of leeway to the companies. And we do expect as early as Q2 earnings, which will start this month, with companies and their management teams actually making commitments and goals to reducing its COVID-related additional debt. Now, move to the slide, the chart on the right, sorry. The cost of borrowing has come down for investment grade companies, as Adrian's already mentioned, but it's actually moved in the other direction for high yield borrowers. So that gap of borrowing between triple B and double B, which is where that crossover is between IG and high yield, that additional cost of borrowing has actually doubled if you go from triple B to double B. It goes from 2.5% up to 5%. And we think in this phase of repair, which will begin as soon as the end of this year, according to the poll that James put out, that we do actually think the interests of bondholders and shareholders will be aligned, and they will begin by paying down some of this debt in order to achieve a higher return on investment. And there will be incentives for companies to reduce their debt, and it will be a voluntary repair of balance sheets.
Nearly 50% of people selecting debt reduction is what they're expecting. Just to flip the question back to you as our credit guy, how do you think the corporate treasurers and CFOs will be, or what do you think they'll be doing with the cash? What's your view?
Well, history doesn't necessarily repeat itself, but sometimes it does rhyme. So if you look at 2008, you did see a period of companies both trimming the fat and reducing their expenses as it pertains to their fixed costs, but also very actively reducing debt to improve leverage, not just through improving and growing their earnings base to grow into the new capital structure, but actively paying down debt before the maturities. And capital allocation policies from companies were very strongly aligned with that, with a lot of support from equity and shareholders as well. And I think this credit-friendly financial policy clearly will be a driver of spreads tightening further, particularly in the investment grade universe, where we still have an overweight allocation.
That makes a lot of sense. And one of the things that also helped, I think that we've seen in the last quarter or so, is how quick they were to come out and tell companies, you need to stop buybacks, you need to cut dividends, or you need to stop dividends to sort of help some of the balance sheet shoring up that we have seen. Okay, perfect. That is that poll done. We've just got one more fixed income slide, which I will pass across to you. I wasn't sure whether it was you or Adrian.
I think I'll be talking about this one. This is really a summary of our positioning and our rationale why. We're preparing for, as I said, a very accommodative central bank policy, which is going to stay for a long time, low interest rates. So basically, we're going to see the government sector and private sector looking to sustain higher debt levels. For this reason, the government bonds, there isn't really any real yield available to me. I'm not inclined to be positioning myself into buying those where I've got a very, what I would call terrible risk reward. I'll be looking at more spread where I've got yield to come in. Has the economics improved, as James has mentioned, or has the corporate start repaying their balance sheets more? So this is why IG, especially triple B, is where I like to sort of position ourselves. That's where the yield will be. I'll be holding those more than government bonds going forwards. High yield, as you can see, they've actually got high debt financing costs. It's going up. A lot of companies are still being looked at by the rating agencies, so there may be some more weakness there, but we can be very selective, and we have been in certain high yield names. We have to look at the actual balance sheet, their sustainability of their debt. Are they also, as Jeff mentioned, friendly? Are they actually on our side to be as bondholders? Are they credit friendly? Emerging markets, okay, I acknowledge there is attractive yields, but until that economic recovery is set in stone, basically you've got too many risks there, I think, at the moment. So you've got concerns over debt sustainability for some countries like Brazil, South Africa. They're still going through the pandemic. I would still hold off there, despite the yields available on offer. And as James mentioned, once we start seeing the weakness of the dollar coming through, that would actually be a beneficial part for us to actually start moving into local EM debt. But I don't think this is the right time for it just yet.
So now we're going to move on to equities. Just going to talk you through a couple of different perspectives. As I said at the beginning, we made our first allocation into core equities. We have got our Q2 earnings season, which is going to be starting in the next week or so. We saw a lot of companies from Q1 refraining to give guidance. So that's putting a lot of investor attention onto Q2 earnings season. We are having this increasing stretching of the gap between sort of fundamental valuation and equity market valuation. Just in terms of a little bit of a brief update on what we have been doing in the portfolio. We started deploying into our coronavirus resilient basket towards the end of March. We've built up our exposure to those names in May. As you can see here, we started to deploy into our recovery basket, building up different selections of names. And then we've added our final exposure to core equity. Ironically, our outperformance has shrunk a little bit as soon as we started adding the recovery names. The resilient names have done exactly what we anticipated that they would do, which is prove that they have business models that can continue to generate revenue and grow, even when we've been in, as James was talking about earlier, a horrible economic environment, given some of the macro GDP data and unemployment data that we have been seeing. We've been playing around a little bit with how to demonstrate this information in the most easy to digest format, and then realized that we're working on the world of investments because we're not very good at making things look nice. So bear with us on this. The video games, online life, and EM consumer all sit within the resilient basket. If you add that up, you're roughly sitting at 8-9% of the portfolio. We've got another 4% which sits in the recovery basket. So you can kind of see the diversity of names, both from a sector perspective and a geographical perspective. And it is nice that we have American, European, and Asian exposure, and some of the best performers in terms of JD.com, Tencent are obviously much more focused on our emerging market consumer themes and ideas. The themes in themselves we've had in existence. I think EA and Tencent we both purchased about a year ago, so it's also been really strong seeing some of our underlying convictions on future strategies and business models coming to the fore as we've held them in the portfolio throughout the course of the year, and they've both been incredibly strong performers. So I'm going to ask Mikhail to join the conversation. We've got you'll be pleased to hear only one last question that we're going to put out. I'm going to pass on to Michael to talk through a little bit about what I touched on in terms of expectation, guidance, earnings, and essentially a lot of the uncertainty that we've been facing within the equity market. And then I'll drop out the poll question at the same time. So over to you, Michael.
Thank you, Simon. Q2 earnings results gonna start to be released in 1 week time, and it's really important. During Q1 earnings results, we've seen that it was not really informative because of lockdowns just started and companies been operating as usual 2 out of 3 months for the quarter, and they've been reluctant to provide any kind of guidance for either Q2 or full 2020. We've seen that the number of companies which provided quarterly guidance staying now almost half of the normal number, 5-year average. And also it led to high dispersion in S&P 500 earnings per share estimations. And we've seen that actually dispersion now staying almost 2 times higher compared to the average levels. This actually raises very important questions. What is the central, most likely scenario for earnings? And to get this, to shape this scenario, we need actually Q2 results to be released, and company supposed to provide any kind of guidance for us just to narrow down these solutions. So moving further, I'm gonna demonstrate you the poll results which been conducted by DataTrack. With a similar question which been asking to you just a couple of minutes ago. So let's move on and look. Okay, so most of participants expect range-bound trading within 5% from current levels for S&P 500. So I would probably also stick with this because of also expect range-bound trading till the year end. So let's move on. DataTrack did a survey and polled 341 investors just to answer a very similar question, and we've seen that distribution very even. Actually, this illustrates that market participants lacking of consensus, and actually it illustrates the point how high dispersion in earnings per share lead to the high risk. So if there is no central solution on risk-adjusted basis, equities stocks looks even worse. So, and also we're talking about S&P 500, which is not only most liquid, but also most well covered by analyst index. So like top S&P 500 companies ordinarily covered at least by 50 analysts, but still we can see such high dispersion in the results. So situation with forecasting emerging markets or smaller companies with smaller market capitalization even worse. So and also S&P 500 has the highest weightage of so-called recession resilient sectors. Ordinary, they're really not volatile, and still there is such a high degree of uncertainty. So on this, let's move further and just look at the valuations for core part of our equity portfolios. We're using top-down asset allocation, with valuation and macro being the most important factors. The 2 main geographies consisting MSCI World Index, US and Europe, now looks really expensive in terms of valuations. So US and Europe valuation based on next 12 months price to earnings ratio just literally went through the roof. And we see this as a really concerning sign. We've seen already that during second quarter, earnings for S&P 500 been decreased, expectations for Q2 been decreased by 37% during the quarter. And actually, it's already we already been under lockdown when started Q2. So moving further to our positioning, we staying underweight equities across the board, which reflected in our current positioning, especially on core part of our equity portfolios. The key factors which we stressing further downside macro and valuations. So we just illustrated how rich valuations at the moment. But on this, I want to stress what is the risk associated with our view. So basically, if we're looking at sentiment indicators, it shows that actually this risk well understood not only by us, but other market participants and already reflected in their positioning. As a reminder, when we just see such underweight positioning and such bearish sentiment with regards equity investments as it is today, so stocks ordinary short-term can move higher. So on technical side, I would stress that the market still staying on their upward channel with Europe and UK still didn't manage to go through a set of important moving averages, while just want to emphasize one more time that macro and valuation is the most important factors for us, and that is why we are still staying underweight our equities. And the main question, how we addressing the issue, that we actually trying to get exposure to equities via satellites part of our portfolios. So we're trying to get exposure to longer term trends, to longer term investment ideas. And interestingly, that current situation and working from home just created opportunities for us to get new long-term trends. And this is something that we're going to discuss just in a few minutes.
The whole concept between the difference of our resilient and recovery baskets was companies with different business models that can continue to grow and are going to continue to grow. At the same time, there are companies that we don't want to own because we don't like their business models. We have a lot of question marks over airlines, hotel groups. We've seen in the UK huge numbers of retailers having to reduce their headcount, upper crust and many others already in central London, and we're not expecting to see workers back into the city centre. We had an announcement from Fujitsu in Japan talking about how they're going to be looking at exactly this thematic topic. They're targeting reducing their floor space by half and trying to encourage workers to work more from home and to look at more flexible and different ways of working. So I'm going to invite Maksat to jump on and join us, and anyone else from the IM team that wants to get involved in the conversation. I'm sure James will be, oh, there we go, popping up as well. So what we just wanted to sort of talk to you briefly about from this side is, working from home is a concept that was happening. We have seen increasingly corporate flexibility on the working environment, but that's been sort of fundamentally not changed, but maybe sped through with COVID-19 being some sort of catalyst. You'll be pleased to hear that we're going to be having this as a little bit more of a relaxed discussion rather than trying to present the ideas, and it's more just to leave you with some points to take away and think about and consider about how this is going to continue to impact the world around us.
Yes, thank you, Simon. Good afternoon, everyone. Thank you for joining our webinar. And as Simon mentioned, working from home has been in place around the globe before the pandemic, but what happened is the whole world was forced into this experiment, which hasn't happened before on this scale. And the key message would be that this is not just a passing phase. This is expected to continue. We have found some evidence in terms of Morgan Stanley doing some surveys of the top management in companies across both sides of the Atlantic, and the view was confirmed that a lot of employees are expected to continue to working from home. This obviously has been the case also within our company. I believe a lot of our clients might have experienced the same or know someone who has been working from home. And this whole trend actually has a lot of implications, not only for the work itself, but for other sectors and industries. And then if we skip to the next slide, one of the key pillars of working from home is obviously technology. And I know, Misha, you've done some research on this topic, and
yeah,
I would like to invite you.
Yeah, let me just provide you some my thoughts about this. So basically, I think that a lot of IT infrastructure already been there, and a lot of companies already invested in some of these pillars. You can see some companies which engaged in the creation of tools needed to create the whole ecosystem just to close this loop for which enables employees to operate on remote, and all companies already been there. So, but some companies obviously they had these gaps in IT infrastructure, which they forced, they've been forced to fill these gaps relatively quickly. And now with investment already made in this into this area, the main question whether actually working from home is the most efficient way of doing things, or maybe employees need to be have to return to the office, or maybe we need like some kind of hybrid model, and it is the most efficient way of doing things. So like my personal opinion is that working from home seems the most efficient, at least short term, once we got a clear workflow. But the main concern coming whether from area where actually employees can generate innovation, whether they can create some kind of new things, whether this is a creativity moment can happen without face-to-face interaction. So I personally think that hybrid model most promising one. Maybe we need some kind of hot desks, and we need to work from home at the same time. So if we, let's say, doing some routine tasks, and it's possible to do on remote, but sometimes unexpected things can happen when people just chat about random things for a while, and after work even, and after just this is aha moment happens, and they come up with a genius idea. So it's really hard, I would say, to do during the scheduled call. We already invested in some of these companies, in particular in Avast, Microsoft, Amazon, Google, Apple, Seagate, either on equities side or fixed income side. And we've seen that as they got new growing driver and kind of faster growing market is a good addition to the original exposure to the original long-term theme. We also, during the quarter, invested in European stocks of European car manufacturers, particularly in Volkswagen and Peugeot, as things that it is the most operationally efficient companies in the industry, and also had the most efficient, most resilient balance sheets. And we started to look at this when we got data from China regarding recovery into the industry. On this, I would like to invite James to talk more about his favorite sector, namely transportation.
Well, I'm going to be very, very brief. I'm not sure it's my favorite sector. A long time ago, I worked for a car company. I think that might be
at least used to be. I'm sure.
So I think one of the areas that that will do well in a sort of a post-COVID world, where working from home is a more consistent part of our everyday experience, is that people are going to be driving in cars more. Just look at London. If you don't need to go into the office, maybe you don't go into the office at all anymore, and you work from home. Maybe you go in one day a week. You move out to the countryside. You need a car. So I see ongoing demand for personal vehicles to be pretty good. Now, I'm just going to take this moment to say that a lot of people have been using flight travel and vehicle miles traveled as provided by alt data sources like Apple and Google as a way of measuring the strength of the recovery. And I think that on the flight side, yeah, that's probably right. People are not getting back into airplanes. They're not getting, that's just not happening. On the automotive side, I think this data that we see on the left-hand side is probably grossly misinterpreted. There's a lot of seasonality to how people drive. So in the US, for example, driving spikes in the summer when people go on holidays, et cetera, and so forth. And a lot of this pickup that you've seen over the course of the past couple of months is probably just seasonal. So actually, I think the driving mobility data by region suggests that the world is healthier than actually it really is. But yeah, I think that if you look over the next several years, I think the outlook for autos actually looks surprisingly good. And that's one of the reasons why we've got Peugeot in the basket. So without belaboring that, I'm going to pass it along, and we're going to have a little quick look at the real estate implications for the work from home environment.
I was just going to say on the transportation side, one of the things that we've seen in the UK with car dealerships having been closed for 3 to 4 months is exactly James was saying, conversations on that side about this kind of idea of your personal mobility vehicle, also known as a car, and people wanting to try and purchase their own cars so that they have the freedom and ability to move around. One of the things that we were looking at from a portfolio perspective was, what kind of cars do people want to buy in the current environment? What we've seen in the UK was a lot of the smaller car dealers that didn't close and continued to do COVID-19 compliant car sales meant that they were able to continue to generate cash because they needed the revenues, being primarily self-employed or small businesses. And they're the ones that then started selling through their stock as people in the UK wanted to try and buy cars so that they could have some sort of mobility, given that public transportation usage has decreased significantly. Then what happened is in the last few weeks, car auctions have started back up again. And some of the auction houses have been saying that previously they'd get maybe 20 people arriving to bid face-to-face and another 20 to 30 people registered bidding online. And that was a kind of normal attendance that they would expect. The first few that have happened have had nobody there face-to-face, but registered people buying north of 300, so 10 times the normal number of people, because the dealers are now desperately trying to replenish stock, primarily in this kind of 2,000 to 5,000 lower end sort of second-hand car market, to the extent where cars were going above sort of book value as dealers are just trying to replenish stock at all costs. So we have seen the transportation market getting skewed somewhat, with people trying to restore their personal mobility. And we've seen people now that we have the ability to leave the house in the UK and go to some other destinations that they wanted to try and make the most of it. and that's factored across. And Max, I don't know if you wanted to talk just briefly about the rationale for the two stocks that we pulled in.
I think Misha summarized it pretty much correctly in terms of those are the two most profitable from operations perspective automakers in Europe, and also with the most resilient balance sheets. So we were comfortable buying them at that point. Yeah, and last but not least is real estate. How working from home has an impact on the whole sector, and I think a lot of businesses are asking the question, well, if we can continue working efficiently remotely, do we really need offices, big offices in prime locations in the big cities? That's probably the question that is coming up or in the heads of a lot of top management businesses across the globe. But we found some data which shows estimates for major European cities, and the outlook for the next 2 years is obviously that commercial prime rents are expected to fall. Now, this has happened in previous economic recessions, but the key difference now is that there were no lockdowns previously. And now that we are undergoing this unprecedented, I'm going to borrow this word from you, James, unprecedented experiment, the question is, do we really need offices that big and also in those locations, or can we probably scale down a bit, save on the costs, and maybe with the new staggered schedules in terms of half of the office workers will be in the office, half of them will be at home, and then we swap. So I guess it's still very much an open question, and we'll have to wait and see how it develops further. But if we look at the other side of the sector, specifically the residential property, what we have seen is that demand has picked up, and I think people are using this opportunity to maybe relocate outside from central parts of the city, which are more expensive to live in, but also maybe less spacious, and to rent a house or a flat somewhere in a rural area, or not the central, at least not the central part of the city, to have a basically nicer home, more spacious. And we've seen data from Rightmove which confirms this thesis, but I'm also speaking from a personal perspective, as we have been considering to relocate from central London or closer to central London to like zone 4 maybe, or even further. And yeah, I guess that's another trend that is ongoing. We will have to see how it develops further. But then again, it's also, I guess, happening globally, not only in London, as we have heard from our colleagues, which are at the moment based in other countries, that the same thing is happening there. But yeah, that's another trend that we will be looking at.
Yeah, I mean, I'll just pop in very briefly and just say on UK Independence Day, July 4th, when we got to go to the pubs again, I actually went and I had a pint with some people from my kids' school, and I live way out in the countryside, like way out in the countryside. I have horses for neighbors, which bring flies, and what the bursar for the school was saying was that in the past several weeks, they had been flooded with applications, like multiples of what they would have expected by this time. They've got parents calling up and asking if they can shoehorn their kids into the school for next year. So it's very anecdotal, just one particular comment. But I think it's very instructive, and it says quite a lot about where I think people are going to be looking to live over the course of the next couple of years.
Perfect. Thanks, guys. I think from my side, in terms of summary, the utilization of office space by companies is going to be significantly reviewed, and you imagine that sort of average floor space requirement is going to decrease now that we have the technology, the software, the internet connection speed, so that even if you are in the middle of nowhere, the sort of you still are able to jump online, participate in webinars, discussions with colleagues. So we are only really now, from a financial services perspective, in an ability where we can function as a team, stay connected, make investment decisions, and continue to manage portfolios. That's going to have huge multiple sector ramifications moving forwards. Yeah, when we're working from home, we're not in London, we're not buying our morning coffee from Starbucks, Costa or Nero, we're not popping out to Pret or Eat or Itsu for our lunchtime meal. We're not occasionally once a month going down to the local pub for a fresh beverage. So what's going to happen to replenish that side of spending? And there are a lot of companies, and we are, as I said at the beginning, already starting to see it, that are going to be having to try to reduce costs to take into account what has been a catalytic change in consumer behavior and work behavior, and the whole concept of office and the requirements for offices for a lot of companies moving forward. So this working from home is not going to be disappearing very quickly. As we showed at the beginning, there's a huge significant portion of employees that are anticipated to continue working from home even after COVID-19 is done, vaccines are out, everybody's fine, more from it's convenient, productivity is not diminishing, and there are a lot of positives to it. Where people are going to be located, that will be one interesting aspect in terms of whether people choose to move further out of London or they keep track of some sort of city exposure because they want the social aspect. So thank you very much for attending. If you've got any follow-up questions, please feel free to get in touch. Otherwise, hopefully we'll see many of you this time next month. But thank you very much. Goodbye.